in. And we do have a wonderful panel and a very spirited panel as well. So without too much time, we'll get right into it. We'll start with some introductions. I'll introduce myself and take about a minute, and then we'll let the others do that. And they can tell you a little bit more about their interests, and we'll jump into the deal. So my name's Al Dampier. I'm a serial entrepreneur and managing partner at Dampier Consulting Group. I typically work with private equity and venture capital in boards, C-suite, complex problems, and chart new courses. And sometimes that's raising capital or what have you, but a lot of different directions that takes me. Wonderful to have a different panel today. And Tony, you're bring a little bit of diversity to our panel in a nice way. So why don't you start us off with an introduction?
Sure. Hey everyone, I'm Tony Saur. I am an attorney here at Morrison Cohen. I've been working with emerging company and VC-backed companies for around 20 years, both on the issuer and investor side. I'm somewhat industry agnostic, but I tend, being in New York, to have a bit of a focus on tech, fintech, ed tech, tech in general. Aside from the sort of the general VC work, I also do VC-backed capital markets work, SPACs, public offerings, and VC-backed M&A work, other exits. That's that's me.
Thanks, Tony. Glad you're here today. And Adam, you want to give us a quick introduction, please, sir?
Great. Thanks for having me, Marty. Quick background, started my career in venture at a small seed fund called Deep Fork 7+ years ago. Then went to a large hedge fund called Anchorage Capital Group, where I was doing Series A through Series C investing out of the fund's private strategy. And then since have started my own firm, Looking Glass Capital, which is a seed stage venture fund based in New York, but investing across the US and Canada. Started that at the end of 2020, been making investments since then out of Fund 1. And we're typically investing $300,000 to $400,000 as a lead or co-lead investor in rounds of $1 million to $3 million across health, climate, and human capital.
Thanks, Adam. And Pierre.
Yes, thank you, Al. Pierre DuPont, and I did have the fortune of meeting Marty decades ago. We'll talk about that after I've forgotten that. I'm a software engineer from the 80s. Back when I met Marty was in my own founding and co-founding of software tech companies, took 2 of them public in 93 and 99, at 01 actually. Then became a private investor throughout the 00s, and in the 2010s decided to do something a little different and moved into the wealth management industry, primarily because I like to proselytize on how to live wisely with wealth, which is far more than investing, although most everyone talks about it in the context of investing. I'm with a firm called Saur Partners. We are very large. We manage about $35 billion at this point for more than 4,000 individual clients. Do the math. Most of them are not venture and direct private investors. But we did just launch, literally this month of June, a private direct program for our larger clients, and we'll be doing quite a fair bit of that, I think, in the next few years. I personally am a very active angel investor, really more of an active angel mentor without investing, and that is my second passion after living wisely with wealth.
Thanks, Pierre. And Harry, the man who needs no introduction.
I can tell you that Marty Cicada is different.
The cicadas, in a good way.
Every 17 years, the cicadas come out. Marty Cicada comes out twice a year.
There you go.
So it's always a pleasure to see Marty. And he's been on the ground for the last, 16 years. Now he comes out. Okay, I'm going to talk about a diverse number of things before I'm officially introduced. Is that okay with the chairman?
Sure.
Okay?
Yeah, go right ahead.
I'm sort of a pioneer. I did a hedge fund in 1980, very successful. I did a corporate venture capital fund with 10 of the biggest companies in the world under one umbrella. I did that very successfully. That lasted 20 years. 4 funds, all very successful. when I talk about making money on some stocks, I don't talk about 20%, 25%. I'm talking about 1,000%. And I'll give you an example of one today, just to show you that I'm not giving you bull. So I'm talking about undiscovered little companies that come out and become huge. All right, I've got one now. So while you're a little skeptical, let me just mention, how would you like a company that's going to do $335 million on the bottom line, which is going to be about 50% of revenues? Revenues will be $840 million. So 4 years from now, this company will do $325 million on the bottom line. And at 20 times earnings, this company will be worth $3.14 billion. You can multiply it out. There's a company you can invest in and make a lot of money, because it won't come out at 20 times earnings. It should be 100 times earnings, because their revenues and earnings are expected to grow 100% a year. So if you know about PEG ratios, PE divided by growth, it should be at a PE of 100, not 20. So I'm saying at a PE of 20, it'll be worth $3.14 billion. But the PE should be 100, because it's going to double its revenues and earnings every year. How do I know? Because that's its backlog. Its backlog is now $3 billion US. $3 billion. It was $2 billion 6 months ago. Now it's $3 billion. Not only that, it's an ESG company, totally ESG. It conserves energy, it reduces pollution, and it's growing like mad. It's moving into North America, Canada, US. Right now, it's doing business in China, but it's not a Chinese company, it's a BVI company. So when I come up with a deal, the potential is you can make 200 times your money, 50 times your money. And when I was running my venture funds, I would have a great deal, and the partners would say, we need that. We got to boost our earnings in this quarter. We're having a lousy quarter. So I would distribute, and they would make the money instead of me. That's okay. So I'm always having fun doing what I'm doing. And so I've gone, well, in SPACs, I did a SPAC in 2008, the only one to succeed out of 36 SPACs. Every one of the SPACs, except mine, gave their money back. Okay? So I do unusual things. And what I'm talking about is venture capital where you're picking the winners. And I've learned a long time ago, I don't care about the losers. I don't care about the ones that make 5% a year or something like that, which are, to me, total losers. I care about, we take one company, and you can make 1,000 times your money.
So Harry, what we're going to have to do on this panel is understand how you figure that out in advance.
I
Well,
figured it out.
that's a great segue, Harry, and thank you for being here and open the door. That's one of the questions I want to throw out to the panel. And you know, how do you seek, find, vet opportunities in your fund? And one of the things you'll find in the audience is that we have some very diverse approaches and some spirited individuals. So this is going to be a fun topic. So how do you seek, find, and vet some of these opportunities? Adam, you want to go first on this one, and we'll circle back to.
I'm going to answer two questions that people always ask. How do you get your money out of China? It's very simple. I get my money out of China by taking all those companies public on NASDAQ. That's the secret. How do you get your money out of China? It's simple. I've taken about 80 companies public on NASDAQ. That's how I get the money out. Very simple. The second thing, families don't get as many business plans as I get. When I was running the money of these 10 corporations, I used to get 10,000 business plans a year. I'm not looking for everyday deals. I'm looking for big winners. If I find one great deal, it's better than finding 10 or 20 or 50 little crappy deals where you can make 20% or 30% a year.
So I think Al question was going to be, how do you find these deals? Is that a fair statement, Al? Is that where you were kind of?
How do they find you?
Yeah, how do they
Yeah,
find-
Well, I go to meetings like Marty Cicada, and I meet a lot of people.
So who in this room is that next deal?
Yeah.
Yeah.
No,
So-
I'm out there.
So
I'm
Harry,
out there doing my thing, okay? I've never lost my energy. I'm running around, meeting people, doing deals, and I'm an older guy now. I've been around a long time, but I've never slowed down. So I'm always looking for the next great deal. And so this deal that I just mentioned to you, the name of the company is Edelson, Enesoon. That's the name of the company. So I did my due diligence on the deal.
you want to put that in the
E-N-E.
chat, Marty?
S-O-O-N.
S-O-O-N.
Like energy soon. Okay? It's going to be public through a merger with a shell. So it'll be public a month maybe from now.
So it'll be a reverse merger?
Yeah, it'll be a reverse merger just to get 350 share owners. What did I do now? The idea is not how do you find the deal? What do you do with the deal when you find it? Here's what I did. I talked with McCooey, the head of Asia for NASDAQ. He's senior VP. All right, anxious to get the company. I talked to ICR. They do investor relations. I talked to them, got their head of Asia Pacific, the top guy. He's going to do the IR for the company.
But Harry, I'm going to interject and object because you haven't said, you said it doesn't matter whether it's a good deal, I think is kind of what you said.
No.
How do you make it? So, but that can't be true.
No, it's two things.
Yeah.
You got to find the right deal, and then you got to make it happen.
So we're gonna.
So Harry, let me interrupt. Yeah, Marty, let me go with some of the thoughts here and get everybody involved because Harry's right in line with where we want the conversation to go. And like I said, it's a spirited group. We'll have to go. Adam, let's jump to you and then we'll come to you, Pierre, and then follow up by Tony. Adam, jump in. How do you find and vet some of these opportunities that are out there? And there's a lot of them out there.
Yeah, absolutely. I mean, Harry is certainly right in terms of leveraging network. The biggest drivers of deal flow for me are other founders that I've worked with before, whether those are founders that I've invested in who want me to back other companies that their friends and colleagues are starting, or even founders that I haven't invested in. And so if you provide value and are helpful to a company, even without writing a check, I found that can still continue to drive deal flow. And ultimately reputation, I believe, is what is driving sort of the vast majority of opportunities that I see. And then beyond founders, the other segment of deal flow is coming from other investors. So the company that Harry just referenced has already raised $50 million. The companies that I'm looking at have raised at the most $500,000. Ideally, I'm looking at companies that haven't raised a dime, and I'm one of the first investors on the cap table. And so the deals that I'm looking at, companies are raising between $1 million and $3 million. And almost all of them are being syndicated across multiple firms. And so there's literally 150 other venture firms and funds and angels that I'm constantly in touch with, collaborating on opportunities with, sharing deals with. And as soon as I have conviction around an opportunity, I think through who are the other 5 to 10 other individual partners at firms that could be a great fit to collaborate with. And conversely, because I'm taking a very thematic and sector-driven approach to what I'm investing in, I'm top of mind for other investors who may have an opportunity that they're leading or they have conviction around and are looking for an investor to come in alongside them. So that's sort of how I'm driving a really curated and targeted set of opportunities.
Yeah, thanks, Adam. Pierre, you go from angel to large funds and everything in between.
Yeah.
How do you balance the risk from different perspectives, since we're talking the larger, the whales that Harry's talking about and some of the smaller investments, even angel investments, 100,000 or so. How do you balance that risk?
You used the right word, balance. You have to balance, and the balance is very different for every person in the room or on the Zoom, and you gotta find and know your balance. That's a different question by person. I would say though that mostly what I do is 50,000, 500,000, maybe $1 million or $2 million into a deal, and I would suggest that at the earlier stage, you need to consider whether you belong in a venture fund, like what I guess Adam was just describing, and maybe you do, because if you don't have value add to help pick the deals and then make them successful, then maybe you're really better off paying a fee and having a professional venture fund of some group do it. But if you're going to go do it yourself, I really believe strongly in the thought that 2 brains are better than 1, and 3 brains are better than 2, and 4 brains are better than 3. Now, at some point, that doesn't work so well when you get up to 10, 20, 50, or whatever, maybe, because you get into bureaucracy. But with 2 or 3 people that you've come to know, that have different expertises to bring to the table, form that team. Doesn't have to be anything formal about it, but get together regularly, look at the deal flow, share that, go out to other experts and do it as a group, because then I think you're much more likely to be successful in picking the winners or at least a portfolio that includes some really good winners, and will also give you the ability to do better due diligence because of a broader set of people. So that would be the basic advice I would give on how to find deals. And of course, you've got your angel groups that most colleges have one amongst their alumni these days. Most cities have one, various regions do. Participate in those actively, pay the fees to be a member of them regularly, and follow that group, contribute to it also. And then get the word out in the family office universe. Let people know that you're interested in these flavor deals of this size and this nature. And that'll do all these things, and you'll begin to have deal flow. But again, you're going to need a group of people that you trust, can work with, and all bring different value adds to analyze those deals, to make the decisions, and then to add value after you decide to invest.
Thanks, Pierre.
To comment on what
Harry,
Adam said.
Well, Harry, you've been on
Adam,
both sides of the deal. You've been on you started your firm many years ago, and some of the deals that Adam's talking about, but also the bigger deals. So how do you go ahead and address both, if you would?
For one thing, you have to go where the deals are. So when healthcare deals are going crazy, I go to Oxford, England, and one day I buy 2 companies, I invest in 2 companies that within a year or 2, they're both unicorns, healthcare companies, Oxford Molecular, Oxford Glycosciences. When the internet is hot in the United States, companies are selling at huge PEs, I go to China. I invest in HongKong.com and China.com. Both of them got to be worth over $1 billion within a year or 2. When I went there, they were worth 20 million. I go where the action is. So if PEs are too high in the US, I'll find a similar company in South America or anywhere in the world. And I travel a lot. I've been to China more than any other person I've ever met, 130 times. Because I don't get jet lag. As Marty knows, I never get sick. I've never had a headache. I've never had the flu. So I go to China to have one meal and take the next plane back. Doesn't bother me at all. So, I go where the action is. If I see something hot in the United States or anywhere, I'm out to get it in a different country where I'm paying peanuts for the deal. So those are some of the tricks of the trade, right? You go where the action is. And if you have one hot deal that's going to be worth $1 billion in a year or 2, it's worth 20 of these crappy deals that you have. I don't care about the crappy deals. I'd rather write them off. I don't need crappy deals. I'm looking for one winner which will pay off 50 crappy deals. So you look for potential. That's what a VC is looking for, potential. We're looking for a company that can be big. And people always say, what's the most important thing you look at? Management? I say no. I fire the management. I don't need good management. If they've got a great product, that's all I care about. I'll fire the management and bring in new management. So management to me is not that important.
Well, I'm going to push back on that.
Okay.
I'm going to push back on that. You must be too late stage to be able to say that, because a product is not a static and done thing, at least not at the early stage.
Well, I'm there. I'm on the board, I see what's going on, everybody is telling me, we gotta get rid of this guy. His wife is blocking everything we do. So this goes on, and then they're written up in a magazine
important
after I
part of
get rid of
being-
him, that I knew
Yeah.
that I should step
But it's
aside.
true, an important part of being on the
Yeah.
board
Yeah.
is being able, and making an investment, is being able to rate the management team, and maybe people
Right.
come and go.
Right.
But to fire a management team, that's
Well,
a big step.
Well, wait a minute, you know how many
Yeah.
boards I'm on? I've been on 200 boards.
Yeah.
I'm talking about some companies where I go
So
in.
gentlemen,
and-
let me redirect us. Let me redirect us back from replacing the management team and the CEO, because that's going to be different at different level of companies, and that's getting us away a little bit from talking about VCs. So I'm going to move to Tony for just a second and say, Tony, as we're talking about this risk and a broad investment pool here, what are some of the landmines from a legal perspective that needs to go into the deal, and what do you bring to the table in that way?
Well, I guess when you're talking about, sourcing deals, we don't claim to be or present ourselves as, finders or investment bankers. But, one of the things that you can leverage, sort of to Adam's point about having a founder network, is, relationships with, kind of pre-vetted clients and, other relationships that we've had either with founders who have exited, founders, that are starting up a new transaction, a new business. We don't, it's not a guarantee that there'll be a fit, obviously, but that's something that as a law firm, you do try to present that as a potential opportunity. Matching folks up. We're always thrilled when we're able to match a fund client with a potential portfolio company. I think that does alleviate some of the risk of going into a situation blind, as opposed to finding someone who hasn't been subject to that sort of vetting process.
Oh, great, thanks.
Yeah.
All right, and I know this is going to really spark some conversation here. We talked a lot about yesterday about starting a VC fund. How do you advise people to start a VC fund? And if you would announce your name, I just got a request from the on the chat. If you would, when you're speaking, just to announce your name. Of course, I'm the moderator, Al Dampier. So you're starting a VC fund. Adam, you just recently started one not too long ago. You're the newest into the group. So why don't you share how you came about that?
Absolutely, happy to. I started sort of breaking into the venture ecosystem a decade ago. I literally cold emailed hundreds of venture capitalists, knowing that I was going back to business school, and was trying to figure out how should I optimize my 2 years of school if I wanted to transition to early stage tech and venture. And I was lucky enough to build a relationship with a bunch of different VCs, many of which I've now co-invested with at this point. And I ended up working remotely for Chris Sacca, who started Lowercase Capital, which is ended up being the best performing seed fund of all time. And through working with Chris, I was able to develop a network of other investors and founders, and then went out, spent several years working at other firms. And it was only after I felt like I had built up a track record of success, having backed a couple of companies that were driving meaningful returns, at least on paper, from a valuation perspective, at $1 billion or over $1 billion, and having spent time at an institutional fund like Anchorage, that I felt like I had the network of potential LPs, whether those are fund of funds, family offices, high net worths, or some institutions, as well as individual founders in my network, that I felt like I was at a spot where I could leverage the relationships I'd built up to start conversations around raising the fund. And really the hypothesis was that I looked at the landscape of early stage pre-seed and seed managers and felt like a lot of them were in the business of raising funds, but not building firms. And for me, there's a very distinct difference between those two things, and really thinking about doing this over the course of the next 3+ decades and building a sustainable and enduring venture franchise, as opposed to preponderance of emerging and early stage seed managers, many of whom are also founders of companies and running venture funds on the side at this point. And really wanted to lean into the institutional experience that I got at Anchorage to drive real differentiation compared to the market. And so it was a matter of putting together what I felt like was a differentiated platform compared to the other firms and individuals that I'm competing with. and then just having lots and lots of conversations, getting lots of no's, getting some yeses, and building enough momentum over the course of that period to get to an initial close. And raising a fund during 2020 during COVID was not particularly enjoyable. I'd say March through April of last year was not a great time to be asking people for money. Not a great time to be doing lots of things, but especially that. And have since got to a point where a third of the fund is invested, have real data to point to LPs who were not part of that first close and are now at a spot where I have a fair amount of momentum and leverage in those conversations. But for me, to feel like I was at a spot career-wise to make that leap was dependent upon a track record that I felt like was indicative of what LPs could expect out of Looking Glass Fund 1.
So Adam, we have a question, a direct question for you out of the audience. And when you started, what was the size check did you write when you were first starting off and building your track record that you have now and or making investments?
So when I started investing at Deep Fork, we were investing on average as a fund 250 to 500K.
We're talking more with your fund.
Oh, with my fund?
Yeah.
I'm investing 300 to 400K.
Was that where you started?
From the outset.
Yeah. The questions with your first check.
Yeah, first check I'm writing is 300 to 400K into $1 to $3 million rounds and targeting on average 5% ownership at entry.
Adam, this is a sort of a leading question, if I may ask. Do you bring in other investors, and would you bring in angels next to you if you had a network of folks that wanted to co-invest?
100%. I frame myself as a first yes investor. In fact, I own the domain firstyes.vc, which redirects to Looking Glass. And so I view my role as someone who can lead and price rounds that are as small as 500K up to $1.5 million. And I've done that in 3 instances already out of Fund 1. And in all of those instances, I've brought in another fund or angel or both alongside me. And then in larger seed rounds.
I'm pleased to hear you say that, because I think that's one of the challenges angel investors often have. They really need to follow someone else. And following another angel is okay, but better to follow a small fund that will, as you say, be a proper lead.
Yeah, I mean, I think angel investors are a critical part of the seed stage ecosystem. Oftentimes, angels are, in some ways, more strategic than some venture funds because they have, they come from industry. They may have very specific domain expertise. They may only invest in one area where they feel comfort, versus a lot of more generalist funds. And even though I'm thematic, I'm more generalist than sector driven in some ways. And so having an investor come in alongside me who has relationships with health insurance companies could be particularly relevant to companies that I've backed in the portfolio that I just don't have. And so I view building a cap table as a way for founders to fill their blind spots, and they should be putting together complementary pieces, whether those are individual angels or funds or family offices that may have built their wealth in a particular industry that is relevant to what the company is building. And it's incumbent upon the investor base to be self-aware enough to recognize where their own blind spots are.
Pierre, you want to add value to that since you started to chime in?
Well, I completely agree, and I guess I would continue kind of what you're saying about the family office or angel investor may have his or her own expertise. That's a really important point. And in fact, I don't really think you want to be an angel investor unless you have something to add from your own background, from your own experiences. So how did you make the money that you have? Were you particularly good at sales in this dimension? Were you a founder of a manufacturing company? So that's an expertise. And were you really good at hiring people and being able to judge how the fit of a team and so on? Did you understand how to do advertising? Those become the expertises you have to bring to the table in order to be a successful angel investor. Find 3 or 4 others who have complementary capabilities to bring in with you. in other areas you don't have.
Hey, Harry, when you put together some of the larger deals, where do you go to find your people? I know you said you're traveling all over and you go to the Oxford Club and different places. Is that where you find most of your contacts? Or through Marty,
Well,
I guess?
as an example, I hold a meeting at a different law firm in New York every month for the last 20 years. So I know a lot of lawyers. I do everything differently than what everybody else does.
Sure, you have to speak to the microphone.
Yeah, so I do things a little differently than what everybody else does. How did I start my funds? I contacted the head of Ford Motor Company, AT&T, 3M, 10 of the biggest companies in the world, Asea Brown Boveri, Reed Elsevier, and they all came in. All of them, 100% came in on a 1-hour telephone call. 100%. Well, I researched them. I knew what they needed. So part of it is research. And then you call them up with an idea and they all bought into it. 100% bought into it. And it was 10 companies in 10 different businesses. I don't know all those businesses. Colgate-Palmolive. What do I know about Colgate-Palmolive? But they came in. So I just contacted 10 companies, and those 10 companies all came in, and they all gave them their special niche. In other words, I got AT&T, I couldn't get GTE, as an example.
So Harry, they didn't know you at that point, like we all know you now, and
Well, they knew me. They knew me. I'm sorry. I used to be in Wall Street, and
So
they
these
knew
people
me
knew
from
you.
my Wall Street.
Okay.
Yeah.
So
Yeah,
what
they
was the
knew
hook
me.
that brought
I
them
was-
in? Just the fact that you were starting a fund?
Yes,
Very good.
yes. It was an original idea to have a corporate venture capital fund, not running pension money, running corporate money. So I was able to invest the money freely.
Very nice. Tony, in starting a VC fund, what are some of the legal pitfalls or legal things that we need to watch out for? I'm not sure what word I'm looking for there.
Sure. I mean, I'll admit I'm not a fund formation specialist, but from a capital markets perspective, it's always important to keep in mind, the securities laws, particularly if you're bringing in sort of outside folks to help find your LPs. There's a new finder's exemption being discussed at the SEC. It has not been approved, but it would loosen up the broker-dealer restrictions on using third-party finders for sourcing investors. Up until now, traditionally, folks have been willing to do sort of one-off type deals where folks might introduce a potential investor, get a one-time fee, possibly based on the closing, and trust that the SEC will overlook that one-off because that person is not in the business of acting as a finder or a broker. But if you find somebody who's helping not only source but negotiate the transaction, or sourcing multiple people, or does it as a business, that's always something that tends to pop up as a potential issue that folks might not be thinking of.
Thanks.
Tony, you mentioned something, if I could jump in, about being aware of the compliance issues when you bring in other people's money into a fund or something. And I would translate that over to the family office world. I know innumerable family offices that grow a bit, and they begin to think, can I bring in some other people's money here and begin to form a fund? And that, I think, gets into really complex compliance issues. And you can do that, but needs to be careful. And I think the same applies, as you were saying, in the venture capital world. You may be a great angel investor, you may be able to do a bunch of SPVs with various people, but to actually get committed capital, you really have to do it properly from a compliance and regulatory point of view. And it's a big organizational burden, in my opinion. So always be very thoughtful before you decide you're going to go down that path, is kind of what I would say.
Exactly. Thank you.
Do the time map.
So, sage advice. So we've got another question from the audience, and this would be a good comparison. What about crowdfunding versus venture capital? Any thoughts there?
I'm kind of a fanatical fiduciary, if you will. It goes with being a professional skeptic. And that basically the problem I have with crowdfunding is that I really believe it's people who are looking for dumb money. And that really does concern me on principle. You know, I'd be careful of crowdfunding only because I think you're going to end up inadvertently hurting some investors. But that's me being too conservative.
I tend to agree with you. Tony, you have a thought? What's that?
Yes.
Yeah, whenever I could tell one of you started to say
Adam,
something.
if you want to jump in, that's fine.
Yeah, I was just gonna say I tend to agree with Pierre that I think for the most part now, and definitely historically, there was an adverse selection bias that if you needed to do equity crowdfunding, then you couldn't raise from institutions or couldn't raise from more sophisticated venture investors. However, I do think there are some there's some exceptions to that rule. So I think if you're building a very community-driven platform where you want individual users to feel like they have ownership over the product and to have an incentive to promote it, I do think there is a lot of value in having people feel like they have skin in the game and really care about what you're building. And that there is an opportunity, whether those people are sophisticated or not, they love the business you're building, they love the product, they love the user experience. And so it's a way to give them, you know, it's kind of like feeling like you own a bar or you own a restaurant, right? Like I use this app every day. It would be awesome if I had a piece of it. And so I think that there is some value in that and carving out a portion of your raise to enable your users to invest directly into the business and feel like they have, you know, an incentive to promote it.
Well, that's an interesting point. Would that increase the marketing, strategic marketing plan for the organization by word of mouth?
I think it's, you know, I've seen it in a number of social and consumer product, you know, consumer internet businesses over the last several months who have allowed much smaller angel checks to come in onto their cap table directly. And it gives that person an incentive to use the product and it gives them an incentive to promote it to their friends. And so I think there is some real value there in taking advantage of the sort of the crowdfunding, new crowdfunding regulations.
So we have about 10 minutes or so and we'll go for some other questions. Marty had a good question, and I see this in Austin a lot. In fact, there's a joke in Austin that I'll share. Something might be valued 15 million in New York, and they'll value it at 7 million in Austin and say, well, this is Austin. So when you start looking at valuations, and whether it's the entrepreneur raising capital, who's got one thought in mind, or the VC coming in with capital, where does the valuation go, and what's the right number?
I would take you, this is Pierre, and I would take you back to your balance question. I'm actually going through an angel company that angel, not an investment yet, but someone I've been mentoring who's got this problem. He basically was offered too high a valuation in his first pre-seed round. And the truth is, he doesn't warrant it. And he's going to pay a big price now on his, you know, common stock when he has to take another round at a valuation. So I think it's important. I think the message that I would make is it's important for an entrepreneur and the angels around him or her not to push, you know, well, the angels wouldn't, but the entrepreneur not to push for the maximum valuation as early as possible, and really push instead that your ability to get to inflection points where your valuation can grow rapidly and it deserves it because you have a product that's on the market, because you have an advertising team put together that's working, because you have partners or whatever, because you hired the team that enables the inflection point in the valuation rather than trying to get a higher valuation earlier.
Al, can we just jump in with Kevin McCann, who runs a family office with focus on venture investing? Just Kevin, you want to just?
I changed my name to McGovern, but that's okay. Kevin McGovern. We're McGovern Capital, and we've been in the business a long time. And this morning I gave a presentation at Camden Well on what we're in. We're in 11 of these industries, and we said, okay, what's the dozen disruptive industries that we think are the most exciting right now? And again, we've invested in 11 of them. We still haven't done anything in drones. So we said healthcare devices and telemedicine, vascular diseases, number one healthcare issue in the world other than COVID, food waves. We have a motto, catch the current, make the wave. Plant-based foods, heavily into that. Cold brew coffee, plant genetics and digital agriculture, plastics to fuel, clean water,
esports, cannabis, huge, and we're a heavy investor, international as well as domestic. Diversity, huge right now. Bitcoins, NFTs, and blockchain. NFT and blockchain. I'm told by my young sports that it is a trend and not a fad. We'll see. Cybersecurity, drones, and lastly, 4D printing. 4D printing is manipulation, organ transplants, et cetera. Those to us are the most exciting areas. And again, we've covered investments in all of them, but just thought I'd add to the little VC conversation here.
I would make a point on that
Yep.
you have a big organization, you have an organization that can help you do this.
Yes, sir.
That your typical angel early stage investor needs maybe not to try to be so diverse and be willing to pay a professional like some of the folks on the panel or others to get them that diversity, because that's
Right.
hard to have expertise that can cover all those areas. Nice to try though, but
But it's
hard.
also nice to know what are the hot areas
Yep.
and what are the ones that some people feel are really going to scale even more. Okay?
Yep.
And these are going to scale a lot more.
Hey, Kevin, we're actually covering half of those topics tomorrow, so.
Beautiful. Absolutely. Yep.
Yeah, so telecom is certainly one of those that I know a lot about, as well as cannabis. So it'd be interesting to hear your comments more about that offline. But I did want to ask about trends in industry. So that's a great segue to our next question as we begin to wrap up towards the end. Who wants to take that one? Harry, you want to go first?
Say that again.
Trends and industry trends.
Yeah, post-COVID trends and industries.
Well, it's good to pick up on trends. I'll tell you the biggest mistake that investors make. When you go in, you got to get in at the right price. It's not just getting out at the right price. When I get in an early stage company, I go in at zero sometimes. I loan them money, get paid back the money. I'm in at zero price because they're desperate for the money and I get a loan instead of an equity investment. So I'm in at the right price. And I've written articles about that. So that's just as important as getting out at the right price.
Harry, you're legendary for getting at the right price. That's a great method
Yeah.
for investors.
So, yes.
Yeah, anyone else on trends?
We have a question, Al, we have a question here, 1 second.
Okay, I've got another question too.
Pierre and Harry, you guys have also figured out, as I recall, in Asia and in China. How have you been able to navigate that wisely?
I did a lot of that. I'll let Harry talk even longer because he's done a lot more of it. But I spent much of the 00's decade going to China, mainland China, only mainland China, and making direct private investments, which were very successful. But I would not go there and make an investment today and have not in the last 7 or 8 years. I wouldn't touch it. Sorry, that's simple. But it was very difficult back then to do the navigation, to build the network. But today, unfortunately, there's a thumb on the board of every company, and it's called the Communist Party. And it's not always so visible, but you can't make a business decision without factoring that in. And therefore, that to me, that means I can't make an investment.
Well, I would invest in China or anywhere. I mean, there's a little more risk when you invest outside the U.S. So you have to take that into account. So I have met with 2 of the premiers of China. George Soros called me up, and I placed the son of Zhao Ziyang, who sided with the students. I got him a job with AT&T, and then sent him to MIT for a graduate degree. I know Chu Ranji very well. So I get in with the higher level people in China. They like me. And every time I go to China, I'm covered by 20 reporters. They think I'm like Warren Buffett. They say, are you richer than Warren Buffett? So I go to China a lot. I have a good reputation there, and I'm not afraid of China.
Harry,
Obviously, I'm afraid of what they're doing out there. You know, they're becoming a little tighter on everything. But if I find a great deal there, I'm going to invest in it.
Harry, next time I need to go with you. I was putting an office in China and I was asked to do a 4-hour workshop on innovation, and they canceled my visa right when I was supposed to board Delta. I got my money back, but I didn't get to go to
Well, I was
Shanghai.
the first one to get a 10-year visa in
Hey,
China.
Al, I think we have another question here, so, yeah.
Yeah, go right ahead.
Curious, having listened to what happened to the old idea that
We can't hear the question.
Well, we're gonna repeat it, Al, don't worry.
what happened
Okay.
to the old idea? In the right price, differently, Being a march on, what happened to the old idea of being there as a partner, develop good company?
I'll repeat it. So, 10 years ago, we had Bob Bozen presenting. He used to be Ron Conway's partner, and he was like, forget about.
Marty, I still
social
can't
media.
hear you.
Yeah, so you guys are gonna repeat this. So, what about companies that actually build stuff?
Well, no, I think the question was, what happened to the model of a venture capitalist, is maybe I want to use the word patient, but that's probably the wrong word, but a partnership model where a venture capitalist helps executives, help founders build companies. And I think that's still true today, but the problem is that most of the venture capitalists, barring the couple on this panel and a number of others too, but most venture capitalists have gone way up market. They're not venture capitalists anymore. They're private equity funds that have a tech risk angle. And they need to deploy tons of capital quickly. And that's, if you follow that argument out far enough, I get to my conclusion, which is that the best place to invest in a venture fund is $25 to $75 million. And you only get one shot, it's their second fund. Because the third time they're going to be raising 150, and they're going to be raising 500, and before you know it, you know, they're private equity expansion capital. So that's the narrow spot. But unfortunately, I think the model of sort of patient, build companies, there's so many people pursuing venture capital, and there's so much money pursuing it, that it's all gone too far up market to do what you described.
What you just described.
Nothing, right? It's not really people.
Well, that's a whole other problem. Yes, indeed.
What you just described is going to be my,
Yep,
that I don't want to invest in fund one,
yep,
if they're trying to figure out what they're doing.
yeah.
Fund two, now they got it figured out, they haven't raised more money to really put the work. Fund two
Is the spot. Yeah. Well, yeah, but it's hard to deploy a lot of money there because they're not very big funds either, so.
not to say I don't do other stuff.
If you can find funds,
If you can still find a fund too, that'll take your money, exactly, yeah. So I think that was a suggestion that Adam needs to be talking to a few people because fund two must be looming close. I'm sorry, I'm not gonna say that.
about 10 minutes out.
Yeah, we're coming to the end here, so
I just wanted to jump on off of Pierre's point regarding the stage of investing and sort of these bloated funds. I 100% agree. I wrote a post. It was sort of the thesis of my firm, which is called The Lost Art of Early Stage Venture Capital, and the argument being these funds now have, you know, they're drunk off of fees. They like having being able to, you know, build out full platform teams. They like having to build out full staffs. And to lead a Series A at this point, it takes $8 to $10 million to get the ownership that you want. To lead a Series B, it takes $20 to $25 million in most of these companies. And so an $800 million to $1 billion venture fund is actually, if you're going to wait to try and get your ownership, honestly, in the grand scheme of things, you're not going to have that large of a portfolio. And so there's only a few firms that have still stuck to their knitting with, I would say, First Round Capital, Union Square Ventures flagship fund, IA Ventures here in New York, who have stayed true to you know, call it $150 to $200 million true early stage fund that can invest as little as $500K up to, you know, $5 million as the first check, invest early when these companies are at their infancy, and really build positions in companies over time to the point that you can invest 3 times into a company by the time it's raising a Series A, have just as much ownership as the fund that leads the A, but put 40% of the capital at risk, and be a much more educated and informed investor because you've been talking to that company every month for 24 months by the time they raise a Series A. But that means seeing things early. It means having conviction early. It means not waiting for all of the data. And actually being hands-on with those founders. But to Pierre's point, most of these firms are, you know, PE firms masquerading as VC firms, and, you know, they're building an index fund of high growth technology companies. Tiger's done a deal, like has announced like 50 to 60 deals this year, if not more. They're not a venture firm. They're a, you know, an ETF basically of hyper growth Series B through Series D software businesses.
I'd like to point out a potential problem. I just wrote a book, and it's on meetings. And actually, Marty is in the book on page 22. So, yeah, so when you get the book, you might want to rip that page out. Yeah. So, yeah, so, but here I am going out to publishers, and they say, if you don't hear from us in 4 months, it means we're not interested. And you believe it, 4 months. Now, I'm going to tell you, I'm different than that. I read everything the day I get it. I don't care if it's 1,000 pages. I read it the day I get it. I have no backlog. So when I'm sending a book in to some publishers and they say, don't call me, I'll call you if you don't hear from me in 4 months, I think that's ridiculous. So if you're a VC, you should read all the business plans the day you get it. You should not wait a week or a month or whatever. You're liable to lose out to someone else.
I have a pretty positive view of most venture funds. They are actually pretty good at managing deal flow effectively and appropriately, and doing a quick scan and giving some quick feedback and saying, no, thank you. But you're right, this is a problem for some, and it should not exist if they treat their deal flow that way.
Yeah.
So gentlemen, we have a few minutes left. I know there's another panel coming up in just a few minutes. So let's go to what have we not talked about that we need to talk about. That just opens the door for anybody to talk about whatever's on their mind that needs to be said. Tony, I'm going to start with you.
Sure. Just to close out that last point, I have also definitely noticed a prevalence of larger investments by, larger funds sort of dominating the environment over this past year or so. Our smaller fund clients tend to be being a little bit more flexible about entering into co-invest arrangements, either direct or through SPVs, as well as thinking about looking into the secondary market, purchasing from employees or funds that are nearing the end of their life cycle. And folks have had some success, particularly when targeting later stage companies, pre-IPO companies in that. The only other thing that I thought I'd mention was, I know that there was a specific SPAC panel earlier this afternoon, but it has also been a fairly big topic for venture-focused attorneys as well, trying to bake in the appropriate protections for potential SPAC and direct listing exits. I would expect even to see possibly the National Venture Capital Association to come out with some specific SPAC language to bake into their forms. But I thought it was interesting because as that's happening and as lawyers are fighting over this specific language as to how to handle a SPAC exit, it seems like folks, particularly on the venture side, are moving away from that a little bit. Not only because of the general decline in the SPAC market, but because of the liquidity issues that they're finding when trying to exit out of their position in a post-SPAC company, whether it be because they're trying to just manage the transfer agent and restricted securities legend removal process, which definitely limits your flexibility and your position, or just that the SPACs aren't being particularly successful by the time the market standoff lockup period ends. You're just not seeing the type of returns that you were hoping for. So those are the 2 points.
One thing that has not been discussed, which is very important, is the market cycle. So if we go into a downturn, how does that affect venture capital? It's great. So if the market goes down, you can get deals at a low price. So I, as a venture capitalist, when there's a down market, that's my chance. Everyone's desperate for money, and I've got the money. So I'm happy in a down cycle.
It's interesting to hear you say that.
October vote 2, you're putting a lot of money to work.
I put a lot of money to work whenever there's a down cycle.
Actually, let me carry that over to this brings back a memory from 1992 when my buddies and I in England had started our computer graphics company, and we were living in England at the time, and England hit a bit of a recession, and I remember this exact thought that we were starting a company at a great time because everyone was wanting to be motoring up again, and we caught that wave. It's kind of a funny tangent to what you just said, but it's the same
Depends on
point.
where you are in the cycle. But if there's despair in the stock market, If everyone is upset, that's the time you can come in and buy a company really inexpensively.
All right, great. Adam, any closing comments?
Yeah, I'll just piggyback off of that last comment around the market cycle, which is which by and large, one of the benefits, in my opinion, of investing at the stage that I'm at is the companies that I'm investing in are fairly well insulated for many ups and downs in the broader market. Certainly valuations might fit, but investing at the seed stage, by and large, valuations are relatively capped in terms of based on what the round size is. I'd say one of the challenges though is when those companies start to mature and they start to become affected by the market cycle. But from a deployment perspective, it's one of investing in these companies at such small rounds at such early stages. By and large, what happens in markets or from a macro perspective over the last 15 months, as there's been more venture dollars deployed than almost any period before then. So,
Thank you, Adam. Well, panelists, thank you so much. I really appreciate the spirit which you've all shared. And Marty, we will turn it back over to you.